morning and welcome to Charting the Markets on Thursday, the 25th of January 2024. Standing in for Sean Morrison, I'm going to talk about the markets today. And first of all, what is of interest is that last night the Bank of China cut its reserve requirements for banks by 50 basis points in order to provide extra liquidity as part of its stimulus plan to try and prop up its economy. And that has led to gains in Chinese stock markets, and we'll look at these in a minute. And we also saw new all-time record highs in the S&P 500 and also in the Nasdaq 100 stock indices. And this ahead of today's advanced US GDP reading for the fourth quarter, unemployment claims, and also durable goods orders out at 1:30 p.m. And obviously, we also have the European Central Bank and its monetary policy meeting today. And we'll have to see whether whether Christine Lagarde will remain quite hawkish or not during the press conference, which will follow that meeting. So let's begin by having a look at the FTSE 100, and we can see that we've been grinding high over the last few days. Yesterday's better than expected PMI data showed that the private sector in the UK was doing relatively well, and that the services sector also saw the highest readings since May of last year, all of which helped the FTSE to rise ever so slightly, as you can see here, and approached this red line here, the 200-day simple moving average, and also the orange line, the 55-day simple moving average, both of which come in between 7,558 and 7,567. Now, on the way up, where we're currently being capped by the market, are the 7,535 to 43 highs going back to mid-November and beginning of December of this year. And they, as you can see here at the moment, are acting as resistance for the FTSE 100. Now, going to the US and hopping over the pond, we can see here that the Wall Street on this daily financial bed, that is to say the Dow Jones Industrial Average, is also consolidating below its all-time record high made earlier this week on Monday at 38,109 on this daily financial bed. And you can see here that we are just pausing in a very healthy uptrend, having broken out of a sideways trading range since the end of December of last year. So even if we were to retrace slightly lower, the previous highs going back to early January between 37,815 and 37,816 basically should act as short-term support, together with the late December high, 37,642. So as long as we stay above there, even if we are short-term retracing lower, the medium-term uptrend very much remains in play. And a rise above 38,109, perhaps after better than expected earnings by Boeing later on today. We'll have to see, because obviously Boeing has taken a hit as its 737 MAX airlines are encountering problems with recently a door having flown off one of its planes. So we'll have to see the impact on that on its earnings and the impact of that on the Dow Jones Industrial Average. If we were to rise above 38,109, the current all-time high in this on this spread daily financial bet, then we could engage the 38,500 mark here. Moving on to the US technology stocks, you can see here the Nasdaq 100 index also losing some upside momentum after having reached new all-time record highs yesterday at 17,668 on this daily financial bet, and that is to be expected. You can't just keep on going in one direction. We saw that at the beginning of January here on the 8th. We had a sharp rally of 3 days, and then we had some consolidation followed by another rally, and now we've seen a sharp rally at the end of last week, beginning of this week. And I wouldn't be surprised if we just lose some upside momentum, which is totally normal. If we were to slip below Tuesday's low, though, at 17,286, we may slide down back towards the 17,000 area and the high seen back in December at 16,978, before then perhaps resuming our ascent. But a rise above the current high here at 17,668 would engage the psychological 18,000 mark. Now, the reduction of the bank reserves by 50 basis points by the People's Bank of China yesterday has helped the Hang Seng index to rise. And we saw Asian markets in general rise on the back of that. And you can see here that we have now risen for 2 consecutive days and are on track for our third day of gains and are heading towards the 11th of January high at 16,445, and also the orange line here, the 55-day simply moving average at 16,682. So further upside likely in store for the Hang Seng, which has had a terrible year last year. If I zoom out onto the monthly chart, you can see here that we've been falling ever since 2018, but since the high in 2021 have really declined from above 30,000 all the way down here to the low we saw in October of 2022. And that low at the moment is currently helping us as support. As you can see here, the current low is made marginally above that low going back to October of 2022. But you could see that last year the Hang Seng was in a very clearly defined downtrend and remains under pressure. The US dollar hasn't done really very much this week, awaiting GDP data out of the US, that is to say, advanced fourth quarter GDP data. And we also expect in the US growth to slow to around 2% per year. And we'll have to see what the GDP data will do to the US stock indices and also to the US dollar. And if you look at euro dollar, for example, you can see that we basically traded in a sideways trading range for the last week or so. Yesterday managed to rise to 109.32 before coming back down again and trading in the middle of this sideways trading range. And even though in Germany today, the IFO Business Climate Index dropped to a 3.5-year low, the euro seems to be rising ever so slightly against the US dollar at the moment. And right now we are between a rock and a hard place between this orange line here, the 55-day simply moving average, and the red line, the 200-day simply moving average, which currently come in between 109.12 and 108.46. And if we were to break out of those, we would have to rise above the high seen on Wednesday at 109.32 for us to then retest the psychological 110 area. And on the flip side, if we were to fall through the 200-day simply moving average here in red at 108.46, we would engage the low seen on Tuesday at 108.22. And failure there could actually take us down again towards the December low at 107.24. But right now, we are literally trading in the middle of the sideways trading range, and it looks as if further sideways trading is at hand. The euro is also quite interesting against the British pound, and you can see here that we fell all the way back from our December high at 87.14 to Wednesday's low at 85.36, as UK PMI data came in much better than expected, and Eurozone PMI data disappointed though. And you can see we saw this hammer formation on the back of that forming, and right now we're just trading and trading water above this 85.36 low we saw earlier this week. Now, if we were to fall through it, we could head back down again towards low seen back in September of this year at 85.24. And below that, we've got a really strong support area between 85.04 and 84.93, the lows going back to July and August of last year. But right now, we seem to be holding above our current low this week at 85.36. And basically, as long as we stay below the December to January downtrend line at 85.78, further downside pressure should remain in play for the euro against the British pound. Now, I'd like to also mention the US dollar against the Chinese yuan, because of the people of the Republic of China's central bank and it cutting its bank reserve requirements by 50 basis points. That led to a bounce in the US dollar, strangely enough, short term. Yesterday, we did slide down to 7.1414, though, on that announcement. But currently, we are once again heading back up again. And that comes after a series of some days of strength for the yuan on the back of the announcement by the Chinese government that it would probably introduce another stimulus package in order to prop up its economy. But from a technical perspective, it's interesting that we held at the 5th of January low on Wednesday, so yesterday. And right now we're heading back up again towards the red line here, the 200-day simply moving average at 719.22. And above there, we also have the December high at 720, which may act as resistance in the days ahead. And if we were to fall further over the next few days and fall through 714.14, yesterday's low, we could be heading down again towards the low seen at the end of November at let me just find this level here, 711 and 24. So that's the next downside target for this currency pair. I'd like to talk about the price of oil and gold and also Chicago wheat now. And let's begin by having a look at Brent crude oil, as we can see here that the price of Brent crude oil continues to advance and is in the process of overcoming its 12th of January high at 80.53 on this front month's futures contract, and is heading towards this red line here, the 200-day simply moving average, and also the late December high between 81.42 and 81.44. And it'll be interesting from a technical perspective whether the rise in the oil price here, aided by yesterday's draw on US inventories, will continue amid heightened tensions in the Middle East. And if we can, from a technical perspective, rise and close on a daily chart closing basis above 81.44. If that is the case, what we would be seeing here is a bullish reversal pattern in the oil price. And that would mean that most likely we wouldn't just retest the mid to late November highs between 83.79 and 84.58, but probably head back up again towards the $90 mark on the oil price. So interesting times ahead. We'll have to see whether the current resistance area between 81.42 to 44, the 200-day simple moving average, and the high seen at the end of December can thwart that upside momentum that we've seen over the next few days or not. Moving on to the gold price slid over the last few days, despite the US dollar not really doing much. And you can see here that we tested the November to January uptrend line earlier today and also yesterday, and held there at $2,011 per troy ounce. Now, as long as we hold there, we may retest the orange line here, the 55-day simply moving average, $2,024. But from a technical perspective, provided we stay below the last reaction high, now that was made on Tuesday, but there's a slightly higher one made last Friday. So therefore, I'd rather look at that one because it's only within a few dollars of the previous high. And that high on Friday was made at $2,039. So for me, provided we stay below $2,039 per troy ounce on this daily financial bet, further downside is more likely in store than any upside reversal. But if we were to rise above $2,039, we could then re-engage with the mid-January high, $2,062. But as I say, as long as we stay below $2,039, the odds are greater that we will actually break through this uptrend line, which goes back to November of last year, and retest the highs seen back in October and also in November, at the end of November of last year, between $2,009 and $2,002. That is to say also the mid-January high of this year. So that's a good support area, a fall through which would probably engage the mid-December low at $1,974, and also the red line here, the 200-day simple moving average at $1,965. Let's have a look at Chicago wheat futures prices, because from a technical perspective, they're quite interesting in that they have broken out of our December to January downtrend channel. As you can see here, we did so tentatively on Tuesday, then fell back and closed below the orange line here, the 55-day simply moving average at 606.79 on this front month futures contract. But then yesterday broke above both that 55-day simply moving average and also out of this downtrend channel and closed above it, which is bullish. And therefore, we now have an upside target, which is represented here by the 200-day simply moving average at 628.49. And then above there, where we do break above this 200-day simply moving average, we could actually retest the early and late December highs between $642 642.80 and 650 on this front month futures contract. And this view is basically technically valid as long as we stay above the current January low, which was made at 580. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @axelar_IG.